So in this video, I'm going to be describing what an episodic pivot is based on my current understanding of the setup. So basically, an episodic pivot is where a stock gaps up at the pre-market into the open due to some sort of catalyst. And that catalyst can be anything from an earnings report, some political or regulatory news, contract or partnership announcement, clinical data or FDA approval, or a sector theme narrative. And understanding these types of setups, in my opinion, or the different types of catalysts, is the most discretionary aspect about this particular setup. And when I'm analysing a specific catalyst, the main four questions that I ask myself are: how credible and material is this catalyst? So is it actually real? Is it just hype? Is it just some sort of speculation? Like how much validation is there to this particular catalyst? How unexpected or surprising is this catalyst? So, in regards to an earnings report, for example, if the company reported some blowout numbers and they were way higher above analyst expectations, then it will clearly be a surprise to the market. Does this meaningfully change the company's long-term outlook or competitive position? So this will probably be more related to a partnership or a contract announcement. So say if some AI company suddenly announced a partnership with NVIDIA, then no doubt they would enhance their competitive position amongst their peers because they would suddenly have a backing of a major player in the sector. And lastly, does this justify a major revaluation of the stock? So based on this new announcement, does this increase their bottom line? Does this increase their fundamentals in some way? And in doing that, would that or does that justify a major revaluation of the stock's price over the long term? So the reason that episodic pivots can trade for multiple days or even weeks is because a strong catalyst can basically fundamentally change how the market views a company. So if investors believe the company's future earnings power, growth prospects, or competitive position have meaningfully improved, they may be willing to pay a significantly higher price for the stock than they were before the catalyst hit the market. So that shift alone in perception brings in new buyers who weren't already previously in the stock, and then at the same time, existing shareholders that were already holding the stock will potentially become less willing to sell because of this new news and the way that they perceive the stock. They already liked it, and now some news has hit the market to make them like it even more. They're not going to sell. And then additionally, in as well as that, short sellers may start covering, and momentum traders will identify this and will also jump in as the move starts to gain traction, and it basically just creates this supply demand shock, and there's significantly reduced selling and reduced supply and only buying entering the market, which obviously creates massive buying pressure and pushes the stock price higher. So even though this is something that I've started to learn through experience, even though the catalyst is what defines an episodic pivot, that is the bread and butter of what this setup is, in practice, I actually look at the technical setup before I spend any time analysing the catalyst itself. So basically, if there's a stock gapping up pre-market, I'll be able to identify that, and before I even look into why that may be, I'll assess the market structure and price action, and then also the volume. So if the market structure or price action isn't constructive to what I deem acceptable, then I won't look any further into the stock. And then if it is, then I'll also assess the volume in terms of the volume in the pre-market session or the after-hours session. Is it elevated or not? And then also the volume coming into the episodic pivot itself. So just following on from that, in terms of market structure and price action, the things that I typically look for, has there been a period of consolidation? And for the real A+ setups, this consolidation period is usually between 3 to 6 months or longer. And basically what that implies is real neglect of the stock. So when this stock has been neglected for so long. There's no people really kind of waiting on the sidelines or waiting to get into the stock, and then suddenly this catalyst hits the market, and it basically creates all this inflow of attention into the stock, and people rush to get in, which creates this massive move to the upside. So moving on from that, has price volatility and daily volume been decreasing into it? That's another sign of neglect, showing that there's with the volatility decreasing, meaning less sellers are selling at the current prices, and then has daily volume been decreasing, again just supporting that idea that no more sellers are kind of entering the market and prices finding an equilibrium. So the importance of that is basically prices found an equilibrium before the EP, the catalyst hits the market, and then it creates this inflow of buyers to skew the supply demand. And moving on from that, is price above the 150 or 200 day moving averages, so the higher time frame moving averages. This is a concept that I took from Mark Minervini, and it's basically just to support that price has started to gain some sort of upwards momentum, and overall the higher time frame trend is higher, so you kind of got the wind against your back. So that just kind of supports the idea that there's buyers stepping into the market as opposed to sellers. Is the price action linear, and is the price history of the chart of the stock showing clean trends, or is there lots of wicks and gaps? So typically, if a chart is showing lots of wicks and gaps, the likelihood of an EP being successful is a lot lower. And then at the same time, you're also increasing the risk of gapping against you. And it can work in both ways, obviously, but ultimately, first and foremost, you want to be managing your risk, especially with high volatile stocks and moves. So they're clear warning signs to be avoided. So, and lastly, does the stock have a history of EPs? And just following on from what I've just said, young stocks may not have EP history, so it's not really relevant to younger stocks. But older stocks, for example, you can just do a quick scan, and it's really easy to find, actually. So if you just go to all the earnings reports, it's, on TradingView, it's really easy to just toggle that. You'll be able to see quickly and identify quickly what the kind of reactions are when that particular stock EPs or gaps up higher. And if is 9 out of 10 times the stock gaps higher on earnings but then fades immediately on the day or the next day, then there's a strong likelihood that that's probably going to be the case, and those types of stocks are the ones that you want to avoid. That last point is probably the one that's the least significant, but ultimately it is something that comes into my decision making. I think it's an important thing to consider. And then in regards to volume, the first thing to check is there large pre-market volume, and ideally is that pre-market volume above the average daily volume over, say, a 30 period, a 20-day or 30 period. And that basically tells you that there's people interested in this stock before the market's even opened. So the likelihood of that stock trading a lot larger volume day than usual is extremely high, and they're the types of stocks that you want to be getting into. So that's the first thing that I'll look at. And then after the market's actually opened, again, you just want to see large volume straight off the open. And ideally that volume should be traded straight away. But if not, then really within the first 15 to 30 minutes of the day, because if not, then there are times where the volume for a stock can come in a little bit later in the day. But really the best setups are always the ones that have massive volume straight off the open. That volume is immediately larger than their 30-day average, and it's a clear sign that there's a lot of interest in that stock for that day. And then another indicator to use for elevated volume is just relative volume, and typically the bare minimum is you want to see at the end of the daily close, you want to see relative volume above 3 times its average volume. So really I like to see higher than that, but depending on the average daily volume, if a stock trades a lot of volume on average, then that relative volume is going to be a bit lower. But really, 3x is the minimum, 5 is better, and then anything above that is a real positive sign that the stock's gained a lot of interest suddenly and that there's a chance for a prolonged move. So that's basically my understanding of what EPs are, and that I think that's that's kind of the foundation into how to assess these setups and identify these setups. And I'm sure my understanding will change over time, but for the most part, that's where I'm starting and how I'm approaching my trading moving forwards.